Hi, Alex Denny here, Head of Investment Trust at Fidelity International. I'm going to talk to you a little bit today about how investment trusts will survive during this time of market turmoil associated with coronavirus, COVID-19, which is clearly hugely disruptive to everyday life and has the potential to be a real human tragedy. As you can see, I'm talking to you from home, where, like many of my colleagues, I'm working at the moment, and indeed an awful lot of people around the country. So forgive my lack of studio environment, but hopefully we'll be able to tell you something useful. So, coronavirus itself, well, I probably don't need to explain that much about COVID-19. Last I checked, there had been about 800,000 cases worldwide, 40,000 deaths. Those numbers are expected to increase tragically. And we've seen lockdowns across many countries in the world, including the UK, where I'm sitting now. Now, the economic impact and the social impact of this is yet to be assessed, but what has clearly happened already is some fairly significant market impacts, and that is something a little bit closer to my area of expertise. I won't talk about any individual investment trusts. I'm not going to talk about the portfolios of the investment companies, investment trusts that Fidelity runs. We're trying to get plenty of information about that online and out from our portfolio managers at the moment. So please do carry on to check out our website or look out for RNS announcements from the companies, or indeed, announcements from other companies about what's going on. But I think it's quite important to reflect on the structure of an investment trust and how it will stand up at this time of turmoil compared with, say, other investment vehicles. So it's probably worth starting with just a quick recap of what an investment trust is. And we're often left with this question of, is it an investment company? So is it a company? And I've described it as an investment company already, or is it a fund? And really the answer to that question is, well, it's both. It is a company, it's listed on the stock exchange, it's got a board of directors, independent, a set number of shares in issue, but it's also a fund because we take money from a number of individuals, we collect that all together in order to diversify risk and to invest in some things that may not be available to most individual investors on their own. And that gives it certain characteristics. So on this slide here, you can see I've described them as collective funds which invest in other shares and assets. Primarily, those of Fidelity are invested in shares of other companies, but it's a company that invests in other companies. The structure itself can be used to invest in other types of things as well, be it real estate or real assets, infrastructure projects. Each company issues shares in its own right, and those shares are traded on a stock exchange, in this case the London Stock Exchange. They have a fixed number of those shares, so basically shares are bought and sold between individual shareholders on a stock exchange rather than being created and cancelled every single day. As companies, they have a legal entity, a corporate body structure, and they can both issue and issue debt and borrow money from banks to invest more on behalf of shareholders. And as companies as well, they've got an independent board of directors. All of which plays into how the investment company structure stands up at a time like this. Just moving back to the coronavirus itself, as I said, clearly a tragedy, but what's happened to markets? And I've got a chart here. I've used the FTSE All Share, mainly because investment companies like ours are listed on the London Stock Exchange. But clearly there's a huge market impact right the way across the UK market, from the shutdown that we've seen in businesses, from the drop in productivity, and this chart, which shows about a 16% drop in the FTSE All Share, but the shape of it is broadly reflected in markets all around the globe, generally with that tail drop off, which you can see happened in sort of February and March in the UK, happening at about the time that coronavirus was discovered in the country or the country went into lockdown. So if you were to look at Asian markets, it's shifted to the left a little bit, and the US is still shifting at the moment. But there has been a real market downturn, and therefore it's had an effect on people's investments, people's pension savings, people's ISA savings already. And that's one of the reasons why I want to talk to you today, so we can think a little bit about where we might go to from here. Investment trusts are obviously part of that market, and therefore share prices have come down. All ships rise and fall with the tide. But there's other aspects of investment trusts which drive the performance as well. Clearly the stock selection of the companies that they're invested in, but some things unique to the vehicle itself. So, for example, investment trusts can trade at a premium if their share price is higher than the value of all of the shares that they're invested in the underlying portfolio, or at a discount, which has definitely been the case over that last few weeks. They can invest in illiquid assets, as I mentioned earlier, and they might invest in some illiquid unlisted companies, or they might invest just in smaller companies where liquidity generally of smaller companies is less because there's fewer shares in issue, the values of those shares are lower, and therefore when people start trading in and out of them, that has a more stark market effect. This third little icon here, a gear, is referring to gearing. I mentioned earlier that investment trusts can borrow and issue debt, and basically they do so in order to gain extra exposure to the market, and therefore the effects of the market are amplified by gearing, and I'll come back a little bit to that. And then this last little icon here, the percentage sign, is about dividends and dividend income. And investment companies have got some particular characteristics about how they're able to pay dividends out of capital or retain some dividend income within their revenue reserves for future years in order to smooth dividends out over the longer term, which is something quite unique to the vehicle. So I'll touch on all of those briefly during the next few minutes. So, I mentioned the fact that investment trusts are traded on the London Stock Exchange. They have a set number of shares in issue, and they can trade at a premium or discount. We've talked a little bit about liquidity as well, and basically a premium or discount is your price to book ratio that you might describe for any other company. So if you add up all of the underlying assets that a portfolio manager invests in an investment trust, you'll come up with a net asset value per share. If the shares are trading on the London Stock Exchange at a price higher than that net asset value per share, we say it's trading at a premium, or that would be having a price higher than your book, and so a price to book ratio of more than 1. More commonly, you'll find that your price to book ratio for an investment company is less than 1, and they're trading at a small discount. And across the sector broadly, which we'll come back to in a moment, that has definitely had a big impact over the last few weeks. Generally, what tends to happen is that the price factor that feeds into this premium or discount amplifies market sentiment. So if you've got a market which is in sell-off, as we've seen earlier, the FTSE All Share was down about 16%. As people get nervous and more shareholders start selling, the share price of the investment company itself starts getting depressed, and therefore the discount will widen out, and you'll have amplified the market loss, or indeed the market gain in an upturn market during that short period of time. And that is shown on this slide here. And I've tried, the two charts are from slightly different areas, so apologies that I haven't been able to overlay them on the same thing. But what I have done is lined up the start and finish of this to cover exactly the same time frames. So this is the calendar year from the 31st of March 2019 to the 31st of March 2020. And the top line is the FTSE All Share, which you can see that steep drop off. And you can also then see the investment trust discounts that moved across the sector from about a 5% discount at the start of the year to something much closer to a 22% discount in the middle of March of this year. And that means that basically the returns in the market have been amplified by that increasing discount as well, because the NAV returns of something investing in just the FTSE All Share would have matched pretty much the line above, but you've seen an extra additional volatility that came out from that kind of drop down in mid-March. But what is encouraging to see, both in terms of the market a little bit, but in the discounts very much more, there's been a real rebound since March as a little bit of rationality returns to the market. So while it was a very stark drop-off that we saw throughout the end of February and into March, it's already started to normalise, and some of that panic has come out of the market, which I think is an important factor to reflect on as we go forwards. One of the reasons for that is that investment companies are able to buy back their own shares, and this is a form of discount control. And I've got a table here, so forgive the rather kind of granular detail. It's not the most stylish looking of charts, but hopefully it lays out the broad principles. So you can see here I've taken a hypothetical example of a company with a NAV per share of £1. And I was assuming that it was trading at a discount of 8%, which is actually not that out of line with many of the equity investment trusts that are out there in the market at the moment. So that means that the share price was 92 pence, obviously below that NAV per share of £1. Now, Normally, markets would just move that figure around, and there isn't a great deal that can be done to influence it unless the board of directors of the company decides it wants to step in and take action to try and narrow the discount. So here I've assumed that they're going to buy back some shares at 93 pence. And that is 1 penny higher than the prevailing share price immediately before they do the buyback. What this does is it takes out some of the oversupply in your supply and demand dynamic and moves the price up a little bit. Now, what they're doing effectively is buying back £1 worth of assets, but they're only paying 93 pence for it. And so they're going to move the discount up from, about 8% to about 7%. And in this instance, I've said they bought 10,000 shares. They buy that at a cost of £9,300 because that's the 93 pence times 10,000 shares. But what they then do is sell assets in the underlying portfolio to cancel out the 10,000 shares that they had. And the 10,000 shares were actually worth, in the underlying portfolio, £1 per share. And what that actually does is it generates a £700 profit to be divided over all of the remaining shares. And so you'll see at the bottom right how that actually works. What we've done is we've reduced the number of shares in issue by 10,000, but we've only reduced the total assets by a little bit less than that. So you can see now that the new NAV per share is 100.07 pence. So it hasn't gone up very much at all, but the new share price is 93 pence. So the share price has moved up by 1 penny. The discount now is much closer to 7% than the 8% it was before. And what we can say in these circumstances is that the actual NAV, the NAV per share performance, has improved a little bit, but the share price performance has improved by basically a percentage, 1 percentage point, by the activity undertaken by the board on behalf of shareholders. So that's one of the things that we've seen starting to narrow the discount in the previous chart, as well, of course, as just market sentiment improving and people being willing to come back to the market. The next thing to consider when we go into a downturn like the one that we've just experienced is gearing. And I mentioned before that gearing is a way of increasing your exposure to market. It's undertaken by the portfolio manager in consultation with the board. But if a company takes out debt and invests more into the market, for every pounds worth of movement in the market itself, you might say see kind of 5 or 10% more movement than that in the NAV per share, which in an upward market, which we've been going through for several years, can be of great benefit. But in a sharp market downturn, like the one we've experienced in the last few weeks, you'll see that the NAV per share is impacted quite quickly by this gearing. And you can see in here the geared line on the downturn gives a lower return at the bottom, and then if you had an upturn, you'll get a higher return on the way up. But clearly, you've got the little blue arrow going up through the middle. What that does is it increases volatility in the share price and NAV. So gearing is bad for you in bad markets, it's good for you in good markets. Now, a lot of investment companies tend to be structurally geared on the basis that markets tend to, over the very long term, increase in value. So a number of investment trusts were already geared prior to this market downturn and therefore have suffered a little bit on that downward trajectory. So, how have investment trusts actually held up through this period? Again, I'm using the FTSE All-Share for a comparison here, and what I've also used here is just the sector average for UK-focused investment companies. And I've used it on a share price basis, so it includes the impact of both discounts and of gearing. And you can see here, over the 1 month period, the performance of companies in the UK oil companies sector to the end of March was significantly worse than the FTSE All-Share by about 10% with the underperformance. Now, if you stretch that out a little bit longer, because 1 month is a very, very short time to look at, actually over the last 6 months, because investment companies had been outperforming the market in the immediate run up to that, actually they've stayed pretty well in line. Over longer periods, the UK oil companies over 1 year, given the very sharp correction, we are actually behind in the investment company sectors on the FTSE All-Share. But over 3 and 5 years, investment companies are ahead, and that's because they tended to outperform in those rising markets. And you might remember in the chart I showed you earlier, the FTSE All Share, the last year or so has been pretty flat. But if you go back, over the course of 5 years, both the FTSE All Share and indeed the investment companies sector had been doing pretty well. But we've seen a lot of that taken out in the last few months. And coronavirus has been the catalyst, I guess, the cause for that big correction down, exacerbated by both gearing and by the premium discount dynamic. So over the longer term, I mentioned that over 5 years the UK company sector is ahead, but there was some academic work done by the Cass Business School just last year. It was published. I think the research was carried out the year before that, but it was looking over about a 30-year period, so several market cycles. It included for example, the credit crunch, the great financial crisis, as it's often called, and said, what happens to investment company performance if we actually ignore the use of gearing and we ignore the use of certain asset classes, like in a statistically important way, basically to say, if you simply take an investment company and said it was doing the same thing as, say, an open-ended fund, how do investment companies perform? And Cass worked out that over those very long periods of time, investment companies tend to outperform by about 0.8% per annum. So I guess the question then becomes, we've had this stark period of underperformance over the last few months. What's working in investment companies' favour now, and will we get back to that period where investment companies are performing well? Well, one of the things that doesn't get talked about enough, I think, in my opinion, is the fact that a shareholder in an investment company has their interests looked after by an independent board of directors. It is a company in its own right, and as I say, the board of directors, there's an annual general meeting every year where these boards of directors are re-elected by their shareholders. And the word independent is important. That I work for Fidelity International and look after Fidelity's investment trusts. I say they're Fidelity's investment trusts, but they're not actually. They're shareholders' investment trusts, and the board of directors do not work for Fidelity. And one of the really stark things here is that the investment manager, so myself, my team, could in theory be fired from the investment companies that we manage if we're not doing a good enough job. That means that we're very much kept on our toes to try and make sure that we are doing a good job. There's a lot of assets in an investment company to lose in one go. So we've got a very close attention on that. And those boards of directors make sure that they're keeping up to date with the portfolio manager and talking to the portfolio manager on behalf of shareholders, just to make sure that the company is being run as they would expect and providing the levels of return. So there's a great chain of accountability for investment companies that doesn't exist elsewhere. And there's also those boards of directors, for example, who choose to carry out a share buyback on behalf of shareholders and consult on the level of gearing. I put in one slide here just on investment companies, which is quite niche, but is very relevant during this time, and it's the ability to smooth dividends. And a number of you might have read in the press recently about operating companies in the wider market cutting their dividends, stopping to pay income because they're worried about their balance sheets going into what is potentially a drawn-out recession, and just to make sure that they're kind of reinforced, ready to kind of ride out the next few years. But of course, if you're an income investor and you were relying on that income for your pension or just to get by and supplement your income, it's very important to know that companies are able to carry on paying them out. And one of the unique things about an investment company within the fund world is that each year we don't have to pay out all of the income that we receive from the companies that pay dividends to the investment trust. And generally, about 85 or 90% of it is paid out, and so there's a good dividend yield on many investment trusts. But some of it is retained for a kind of a rainy day fund, if you will, called a revenue reserve, which means it can be paid out in future years if there is a cut to dividends within the underlying portfolio. And you can see in this chart here, you've got the little brown line is talking about the increase in the income reserve, the revenue reserve ready to pay out in the past. And you can also see some brown lines saying about a dividend paid from capital, such that if it was actually not possible to keep a dividend at the same level as the previous year in order to make sure an investment company is still looking after its income investors, then it is possible for them to dip into their own pockets, if you will, within the net asset value and pay some of that capital out to shareholders to maintain a level of income so that pensioners aren't left high and dry. Now, in many cases, the income reserves for investment companies is more than a year's worth of dividend anyway, so I think it's quite unlikely that lots of them will end up dipping into capital. But I guess it gives that kind of extra flexibility to companies to make sure that a dividend can be maintained, even in a difficult environment like this. And actually, the ability to pay a dividend often drives share price performance as well, so helps underpin the level of discount or premium that a company is paying. Is trading at, sorry. Now, all of this sort of sounds very encouraging. I've said that investment companies can, bounce back. They do well over the longer term, but we've seen this very stark fall. So, do we know that it's going to recover going forwards? Well, absolutely, we don't know anything, and past performance is never a real guide to future returns. But I do think it's very telling to look back at what happened during the credit crunch, the great financial crisis of a little over 10 years ago. And I've put down here on this chart some numbers. They go up to the 28th of February. I promise you that's not a kind of a fiddle that I'm doing, figures to the end of March for now and to the end of February 10, 11 years ago. The reason I've gone to the end of February is because actually that was one of the worst periods, the end of February 2008 into 2009 in terms of performance. And you can see here that investment companies did not hold up terribly well in the year to the end of 2009. So investment companies across all sectors were down 37% year on year. Unit trusts, open-ended funds had performed somewhat better, were down 27%, and the FTSE All-Share was also down 33%. So you can see that investment companies in that year underperformed the FTSE All-Share, and they actually underperformed it by a sufficient margin that over a 3-year period investment companies had also underperformed by the time that you got to that bottom of the market point. Over a 5-year basis, however, investment companies were still in positive territory, despite seeing a 37% fall in a single year, and over a 10-year period were streaks ahead, having returned 35% against the FTSE All-Share, which during that time had returned minus 7%. But if you fast forward a year from then, the rebound was pretty quick. Across the market, but also in investment companies. And the rebound in investment companies, it came up 48% in that year, a little bit ahead of the FTSE All-Share. It hadn't actually, by the end of that year, made up all the ground it lost against the FTSE All-Share. But again, if you look over a 5 and 10-year period, investment companies were streaks ahead of the market. And so I don't want to downplay, I guess, the downside risks of investment companies at a time like this. They can be pretty volatile, but the upside returns can also be pretty quick. And therefore, if you're able to ride out the storm, it's often at times like this where you'll see some of the big upticks in the market as well. So, just in terms of conclusions, investment companies have proved pretty robust over a long history, and you might have heard in the last year or so that investment companies have now been running for over 150 years, and over that time have definitely outperformed nearly all of the indices that you could measure them against, although 150 years is an awfully long time for most people's investment horizons. Over the short term, performance can definitely be volatile. They amplify market movements both through their use of gearing and because sentiment driving premiums and discounts, where discounts often widen out during market downturns, can make them a pretty bumpy ride. It makes them a great investment opportunity if you don't have any investments at those bottom moments, but timing the market is always a bit of a mug's game, and I wouldn't recommend it at all. But if you're able to sit it out over those 10-year periods, the 20-year periods, the 30-year periods that people are saving for their retirement or for their futures, investment companies have a good habit of coming back. So, as I say, they can suffer in difficult markets, but they can rebound quickly. They still have an excellent track record over the longer term, and I think it's really key to remember that they've got a board of directors looking over our shoulders, looking over the managers' shoulders, and keeping us all honest and trying to do absolutely the best thing for shareholders. So I've got good hopes that investment companies will rebound from this crisis as they have done from others in the past. So thank you very much for listening. I'm sorry that I'm not in a studio environment. Please all stay safe and well. And if you've got any questions, please don't ever hesitate to get in contact with us. Thank you very much.